Glyn, thanks for joining us. If we look back at the last 3 years, say, always around this time of year, the Northern Hemisphere is moving into summer, period of market weakness. That happens last month in June. What then happened in July?
Well, I'm not sure about the seasonal pattern. Yes, there is some degree of seasonality in the Northern Hemisphere summer, but the real issue in June and July was that we saw a complete sort of mirror image of what happened in July occurred what happened in June occurred in July. So in June, the Fed started making comments about an end to ultra-loose monetary policy, the so-called tapering, cutting back on asset purchases. There was a big negative market reaction. Let's call it a risk-off month, using the jargon. Then during the course of July, the Fed, both Bernanke, the chairman, and other Fed governors started to calm the market's fears down a little bit, pointing out that any end to QE is some distance ahead, that any tapering is going to start relatively modest, and it's very much data dependent. So I think the Fed had probably been concerned about the scale of the market reaction in June. And remember, interest rates on 10-year government bonds rose by a full 1 percentage point in a few weeks as a result of those comments, and risk assets went down quite a lot. These comments, just to sort of allay the market's fears, calm things down, resulted in pretty much all of the ground being lost in June, recovered in July. So a complete sort of mirror image of what happened in June occurred in July.
Okay, so how did that translate into markets? Let's say we start with equities.
Well, equity markets were led yet again by developed markets. The MSCI World Index for developed markets was up over 5% in the month, so regaining nearly all the ground lost in June. Led yet again by Wall Street. The US was up 5%. Very good performance as well from Europe. Europe up about 6%, the UK up even more than that, close to 7%. So markets dominated by those big developed markets. Interestingly, Japan, which of course had been extremely strong for the previous 9 months or thereabouts, just going through a consolidation phase here, was flat to slightly down on the month. And Asia ex-Japan, although it was up a little bit, up about 3%, still underperforming the world quite a lot, and actually still down for the year to date. So the markets were yet again led by developed markets. In contrast, this underperformance that we've seen from emerging markets continued through the month. So emerging markets recovered slightly, but remember, developed markets up over 5%, emerging markets up only 1%. Year to date, developed markets, MSCI World up 14%, emerging markets down 9%, a huge 23% performance differential. And I think one of the really notable things about what's happening in this surge in developed markets, big underperformance of emerging.
Absolutely. You spoke at the beginning, interest rates up significantly in June. Again, what was the picture for bonds last month?
Well, we saw this sharp rise in interest rates across the US, Europe, UK in June, as you rightly say. 10-year yields up about 1%. We saw some stabilization of that picture in the course of July. There was not a big drop in yields, so the US Treasuries were slightly down still in terms of total return in the month. In contrast, European bonds and UK bonds returned about 0.75% in the month. So, but I would call it a stabilization in safe haven government markets, with yields stabilizing at these new higher levels compared with a couple of months ago. So maybe to some extent the market has discounted some of these concerns about tapering. But it was, as I mentioned earlier, a risk-on month. So we saw credit performing much better, and generally speaking, investment-grade credit did quite a bit better than government bonds. High yield returned almost 2% in the US in the month, more in Europe. Convertibles were very strong again, up nearly 4% in the month, and of course that's played well in our portfolios. We've got quite a nice position there. Generally speaking, we saw a return to sort of risk-on conditions. Safe haven government bonds flat to slightly up, credit doing actually really rather well. The only area that it did pick up a little bit in the month, emerging market bonds, but not by very much, constrained by the issues that prevail in emerging markets generally.
Do you want to talk about that, perhaps, monetary policy in emerging markets?
Yeah, I think it is an important issue because, as I mentioned earlier, we've seen this big underperformance of emerging market equities over the best part of 12 months now versus developed market equities. What we have seen is quite a sharp fall in emerging market currencies, generally speaking, over the course of the past few months. And they've fallen to such an extent that quite a number of countries in the emerging world have tightened monetary policy to prevent further declines. Because, of course, quite a sharp fall in currencies has inflationary implications. So in July we saw India, obviously one of the big emerging markets, tightening monetary policy, raising interest rates. We'd seen the same from Brazil, from Turkey, from Indonesia and so on in earlier months. Part of this process of trying to stop the decline in currencies, and of course a tightening monetary policy is generally not very good for equity and bond markets in those countries. But we've also seen quite a deceleration in economic activity in the emerging world. I think we all tend to focus on China, quite rightly, it's very big, but we've seen quite a sharp slowdown in Brazil, obviously a commodity-dependent country, but with quite slow growth in Brazil. The same in India. China has slowed down to about 7.5% growth. I mean, those numbers of 8, 9, 10% growth that we saw in the past decade, that's a thing of the past. We're not going to see that again. And in fact, the general data coming out of China, to the extent it can be trusted, has suggested that growth remains somewhat on the weak side. And one of the very best indicators of seeing what is happening in the Chinese economy is how are Western companies, developed market companies, doing in China. And one of the interesting things coming out of the results in the US recently is big companies, Apple, McDonald's, Coca-Cola, have all actually referred to weakness in China being a reason for actually poor results from that part of the world. So China has certainly been weak. There were some measures taken by the authorities in China to try to stabilize that growth. Clearly they don't want growth falling dramatically. And towards the end of the month there were some signs with purchasing management indices coming out of China that things were beginning to stabilize. But what we've effectively seen is tightening monetary policy, weakening growth, impacting negatively on emerging market performance.
There appears equally to be almost a consensus emerging, as you say. Big CEOs are coming out and saying that China is struggling.
Yes.
Yes. Can it become a self-fulfilling kind of prophecy, effectively? China sneezes, Australia catches a cold. Is that true?
No, definitely true. Absolutely true. Yes. The reason that Australia is in some difficulty now is that, of course, it's had a commodity boom. What people call the super cycle in commodities. We never ascribe to that theory. Commodities are a highly cyclical industry. That remains the case. China's at the margin has been the big buyer of commodities. We've seen actually quite a slowdown there. Commodity prices have weakened. It bounced a little bit in July, incidentally, but they've generally weakened quite a lot over the past 12 months or so. Australia, of course, is caught in all of that. So we're now seeing a very significant slowdown in the Australian economy. Their fiscal deficit is much higher than anticipated. The Reserve Bank of Australia cut rates in the month by 0.25% to 2.5%, a record low, so facing much more difficult conditions. And the Australian dollar, which had been, in our view, one of the most overvalued currencies in the world, is now down about 14% so far this year. So catching up with reality as this commodity cycle has clearly turned.
Going back a little bit, the Fed talk appears to be leading markets. What then did we learn in July?
Yeah, I think the Fed talk, we've talked about lots of things, but the Fed tapering talk is without question the key issue here. So bond market interest rates going up clearly is a tightening of monetary policy. The Fed does not want to tighten too early. A premature tightening of policy when recovery is still relatively fragile, when there's still high debt levels around the world, that would be a very negative thing. So what we saw is the Fed referring to the fact that unemployment still remains an issue, that they have concerns that low levels of inflation in the US suggest that monetary policy should remain very loose. They've made it very clear that any tapering of asset purchases, the QE program, is data dependent, so everybody's looking at the payroll numbers, everybody's looking at inflation numbers coming out of the US, and employment numbers generally. We saw a similar pattern then from the Bank of England and the ECB. In fact, the ECB, the European Central Bank, for the first time in its 14-year history, gave some guidance about the future direction of interest rates. It basically said that it could see no reason for ECB interest rates to rise for the foreseeable future. And I think actually guidance may well become clearer as we go through the next few months. The Bank of England, under new Governor Carney, made a similar sort of comment about forward guidance, expecting no rises in interest rates for some time to come. I don't think rates in the UK will rise for a couple of years at least. And actually, the new governor referred to the fact that the effective tightening of monetary policy with interest rates in the bond markets going up was actually not consistent with the underlying economic conditions. So although we're seeing some recovery happening in the UK, as we've been predicting all of this year, and Q2 GDP numbers were actually quite good in the UK, 0.6% growth, this recovery still remains quite fragile, and of course the central bank does not want to jeopardise that sort of nascent recovery.
As you say, I guess the big question is, is tapering in fact justified? And for the answer to that, we need to look at the real economy. So
Yes.
Again, let's say the US, Europe. What did we learn last month?
Well, I think what we're seeing now is that the Fed will probably start the program of tapering, cutting back on asset purchases towards the end of this year. The market consensus is still saying September. We've had mixed numbers on payrolls. I mentioned earlier that payrolls are a critical thing. We've had mixed numbers there, with actually the payroll numbers, which is job creation in the private sector, slightly below expectations, but the unemployment rate has fallen to 7.4%. So the market's still saying in September we'll get some tapering. In other words, the Fed will start to buy less bonds, treasuries and mortgage-backed bonds, on a monthly basis than it's currently doing. But the Fed has reiterated time and again in the past month that it's a slowdown in the rate of purchases. There's still very loose monetary policy, and they've made it very clear that that has no impact on the timing of the next interest rate, or the first interest rate rise, which I think will be well into 2015. The same applies in Europe, the ECB, in the UK with the Bank of England, and in Japan with the Bank of Japan. Those three central banks are going to keep monetary policy very loose for a very long time to come. So there's been this reiteration of the fact that policy will remain very loose. So I think we've got a combination of loose policy, gradual recovery in economic activity. We saw some quite encouraging numbers, early signs of a pickup in manufacturing in Europe in the month. So gradual pickup in activity in Europe, UK, US. Things beginning to look a little bit better in Japan because of the reform program there, together with loose policy. Markets, I think, will stay a little bit edgy, a little bit nervous ahead of the first move by the Federal Reserve to cut back on asset purchases each month. But it's, the key thing to remember is that there's still a huge amount of money going to be pumped in by all the major central banks into the global economy for quite some time yet. And interest rates are going to remain where they are today, virtually zero in the US, UK, Europe and Japan, certainly through the whole of next year and probably through a decent chunk of 2015. So that's a pretty supportive environment for equity assets.
Absolutely. 2011, Clint, we get about 5 months of weakness around this time of year. 2012, it's about 3 months. What do you potentially see going forwards from here?
I think there's a pretty good chance that markets will consolidate. A little bit of backing and filling. June was weak, July was strong. I think we'll see markets consolidating, possibly drifting a little bit through the next few weeks. You mentioned earlier, Northern Hemisphere, summer, quiet time. But much more important than that, the markets are waiting for this first Fed move. So looking at the data very carefully, watching what's happening. And I think until we get that first move, markets are going to remain a little bit sort of flat, consolidating, drifting down a little bit wouldn't surprise me, but I'm not in any way concerned about that. It's almost a sort of a healthy development after the sharp rises we've seen over the previous 12 months. So I think once we get through to the stage, sometime in the fourth quarter of this year, when the Fed says, yep, okay, we're going to cut back from $85 billion a month to whatever the number is, 60 billion, then I think the market will say, okay, now we know the situation, and it'll start to pick up again.
Clint, thank you very much.